This is an Uncovered Japan Company research report on Tokyo Steel MFG Co. Limited, ticker 5423. Tokyo Steel is Japan's only independent electric arc furnace maker with a full flat steel lineup. The investment question is whether its low-carbon steel position and unusually strong balance sheet can carry it through a very visible earnings trough. The snapshot captures the tension in this case. Tokyo Steel traded at 0.78 times book value and held about 74 billion yen of net cash, with a 75.8% equity ratio. But operating profit fell 76% in fiscal 2026, and management guided to a 4 billion yen operating loss in fiscal 2027. The product is straightforward, but strategically important. Tokyo Steel melts recycled scrap in electric arc furnaces, then turns it into structural beams and steel sheet used in construction, autos, and housing. Its report argues that it is the only independent Japanese EAF maker with a full flat steel lineup, combining a broad product range with a lower carbon production route. The top line shows a classic steel cycle. Revenue reached 367.2 billion yen in fiscal 2024, then fell to 268.1 billion in fiscal 2026 as the metal spread narrowed. Management guides to a volume-led rebound to 315 billion yen in fiscal 2027, but not yet to a margin recovery. The operating profit guide is a loss. The profit chart makes the trough more explicit. Operating profit fell from roughly 38 billion yen at the fiscal 2023 and 2024 peak to 7.2 billion yen in fiscal 2026. Fiscal 2027 is guided to a 4 billion yen operating loss. Net income has been less volatile because one-off items have provided some cushion, so the operating line is the cleaner way to read the current cycle. Tokyo Steel's balance sheet is the stabilizer. Its equity ratio rose to 75.8% in fiscal 2026, while return on equity declined to 5.4% as the cycle weakened. The report describes roughly 74 billion yen of cash and no debt. That does not remove the earnings risk, but it makes the guided loss more survivable than it would be for a leveraged steelmaker. Cash flow is the important counterweight to the balance sheet comfort. Operating cash flow turned negative in fiscal 2026 for the first time in the series, and free cash flow was negative 14.1 billion yen. Investors therefore need to watch whether volumes and the metal spread recover, rather than assuming the cash balance alone resolves the operating challenge. The business has a tangible, if cyclical, moat. The report points to about 90 years of scrap-to-steel know-how, a full flat steel range that few independent EAF producers can match, diversified customer exposure, and a practice of publishing monthly prices. Those features do not stop commodity cycles, but they help Tokyo Steel compete when end markets recover. The strategic upside is decarbonization. Electric arc production uses recycled scrap, and that can make Tokyo Steel's output attractive as customers look to lower the carbon intensity of construction, auto, and housing supply chains. The report cites early design in progress and an ambitious EcoVision 2050 path, including a plan to roughly double crude steel output by 2030. The opportunity is real, but execution and demand timing remain the key tests. Valuation is counterintuitive at a cyclical trough. Tokyo Steel showed a trailing PE of 15.1 times, which looks high beside steel peers because its earnings have compressed. At the same time, it traded below book value at 0.78 times. The report's peer comparison places Tokyo Steel at the lowest fiscal 2026 operating margin, so a simple PE comparison can be misleading until profits normalize. The author's scenarios underline the uncertainty. The report frames a one-year range from 1,400 to 2,400 yen, and a three-year range from 1,300 to 3,600 yen. Those are research scenarios, not price targets. The variables to monitor are practical: the metal spread, construction demand, the pace of volume recovery, and evidence that low-carbon steel design-ins are converting into durable business. The balanced conclusion is that Tokyo Steel has a distinctive position, an independent, low-carbon EAF steel franchise with a very strong balance sheet. But it is also at a cyclical earnings and cash flow low, and the recovery cannot be assumed. For the full evidence, including the scenario work and risks, continue with the free Uncovered Japan Deep Dives. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.